Welcome to our new video related to the margin analysis of a water company. Remember our first video. Performing an effective corporate financial analysis requires to follow a 4-stage plan. Wealth creation requires investment that must be financed and be sufficiently profitable. Today, we will focus on stage 1, wealth creation. Margin analysis is a key step in any financial analysis of a water company. The assessment of a company's margin and benchmarking to its competitors within the same industry tells a lot about its strategic position. Nevertheless, in some countries, it is common that the national water operator has a monopoly which, in turn, limits the shaping of profit margin analysis over the growth of a single company in terms of sales, costs, and profit over a period of time. It is also common that water companies fail to sell their products or services to their customers at above their cost. The government can therefore help them with subsidies. The key financial statement needed for profit margin analysis is known as the income statement. The income statement is a document showing all wealth-creating revenues and wealth-destroying charges during the year. It is also called profit and loss account, P&L, or statement of comprehensive income. There are two main P&L formats, the by nature income statement and the by function income statement. The by nature income statement is produced according to the nature of revenues and charges. The by nature income statement format shows material consumption, staff costs, external costs, and depreciation. It is also referred to as the by category income statement format. If you are looking for the staff cost, for example, you can easily find this information in the income statement, in red in our example. The by nature income statement format shows the separate types of margin in blue on this slide. A by function income statement displays the expenses disclosed according to their functions such as cost of goods sold, selling expenses, administrative expenses, other expenses or losses. The bottom line remains identical whether you make use of one format or another. It is the net profit. If you are looking for staff costs, you cannot find this information in the by function income statement. You may find this information in the notes to the financial statement if it is available. The water sector is always regulated, which forces companies to submit regulatory financial statement to comply with local regulation. This slide shows a UK mandatory P&L with a focus over two analysis axes, wholesale and retail water sales. We can use the P&L to calculate intermediate operating totals. It is margin analysis. We have different ways of calculating net income so as to break down a company's earnings in different ways and for different purposes. Depending on the format of the P&L provided by the company, and additional information available in the notes to the financial statement, it is not always possible to compute all margins. A relevant financial analysis involved the side-by-side comparison of the financial results of an organization for a number of consecutive reporting periods, generally 3 to 5 years. So computing margin is the start of a good financial analysis. So let's start with the first level of margins. Production contains net sales, changes in inventories of finished goods, work in progress, and production for own use. In the water business, water sales account for the largest share of total revenues, whereas sometimes service sales are material and must be analyzed. Production represents what the company has produced during the year. This picture is a good summary of why you should focus on net sales instead of capitalized production or change in inventories. Projection for unused or capitalized production means unsold production, and it is valued at production costs. Net sales means cash. Methods for valuing capitalized production are subjective, and as such, the capitalizing of production in the water business should be done carefully. Management may use it to drive the bottom line superficially. Sales growth needs to be analyzed in terms of volume, quantity sold, and price trends, organic and external growth. The financial analyst will focus on volume effect, for example, with calculation concerning the new meters or water loss reduction policy impact over the sales. Pricing policy is another key factor in understanding the sales growth, even if the price of water is generally fixed by the government. External growth transactions, they are generally quite uncommon in the water business sector. The value added is an important level of margin. The value added by the company to goods and services purchased from third parties through its activities can be an interesting indicator. On the by nature income statement format, value added is equivalent to the sum of gross trading profit and profit on raw material used less other goods and services purchased from third parties. For the by function income statement format, value added is equivalent to the sum of EBIT, depreciation, amortization, and impairment losses on fixed assets, personal expenses, and taxes other than corporate income tax. The emphasis with value added is not necessarily over the internal-external distinction, but which specific value creation strategy, in other words, a way of differentiating its offering from that of its rivals in order to generate a revenue stream a company formulates. So value added is useful in understanding the sector. It constitutes a measure of the integration of the company in the sector. Integration generally means good cost control but high fixed costs. So there is no good or bad integration level. It's a matter of strategy. For example, in the water sector, should water network maintenance be outsourced or not? When analyzing costs, the following factors are to be assessed. Raw materials used and other external charges which need to be broken down into their main components. For example, transportation, distribution costs, advertising. And they must be analyzed in terms of volumes and prices. Personnel costs, which can be used to assess the workforce's productivity and the company's grip on costs. EBITDA is another key margin. It is the result of the operating cycle, which is equal to the balance of operating revenues and cash operating charges incurred to obtain these revenues. EBITDA is also called operating profit. The calculation of EBITDA is not officially regulated. EBITDA is not affected by non-cash charges. The EBITDA is a good proxy for cash generation capacity of the company. A negative EBITDA means that the company is facing some operational difficulties or that it is poorly managed. So you take value added, you deduct staff expenses to get the EBITDA. EBITDA means earnings before interest, tax, depreciation, and amortization. We have two types of charges, non-cash and cash charges. The most common non-cash charges are assets depreciation or allowances for impairment. Depreciation and allowances are called non-cash charges insofar as they merely reflect arbitrary accounting assessment of the loss in value. For example, if the water company has built a 100 million euros dam to be used during 50 years, I will book in the P&L a 2 million euros annual depreciation expense, which reflects the loss in value owing to its physical use. There is no 2 million cash out every year because a 100 million cash out already took place the year the dam was built. EBIT is the operating profit. It is also an important level of margin. Operating profit is EBITDA minus non-cash operating costs. EBIT is key to assess the operating performance of the company. We conclude our financial analysis with 3 margins easily understandable. Net financial results reflect the company's financial policy. Heavy financial expense is not sufficient to account for a company's problem. It merely indicates that its profitability is not sufficient to cover the risk it has taken. So, current profit and loss, profit before tax, and net income are the 3 margins easily understandable. When a water company manager wants to keep the profit margin high, he can make use of several levers with the extensive level of effectiveness. This slide lists some of these levers. So you have increasing tariffs, reducing technical losses, and cutting operating costs. Increasing tariffs is probably the most powerful lever. However, remember that water prices are highly regulated. Reducing technical losses. You have non-accountant water and non-revenue water you can focus on to increase the margin. Cutting operating costs. You can cut costs of major operating expenses. You can upgrade or diversify production capacities, and you can rely on prepayment by customers or outsource to private local operators to reduce costs. We can conduct a break-even analysis in the water business from 2 perspectives. On the one hand, does the water bill cover operating costs? On the other hand, does water bill cover operating costs plus investment costs? What is the EBITDA margin target? EBITDA to sales ratio should exceed 20%. Why 20%? EBITDA is a level of margin without depreciation and financial expenses. It is necessary to renew fixed assets and pay interest on loans. In the water business, fixed assets account for a large part of total assets. Be aware of the capital-intensive nature of the water business. EBITDA is one of the 2 components of cash flow generated by operating activities. The purpose of the cash flow statement is to provide information about where cash was generated and what cash was spent on. Cash flow from operation involves the inflow and outflow of cash in the course of running the business. This involves cash received from customers and cash spent on salaries, inventory, rent, supplies, and other similar items. Add all the cash inflows and subtract all the cash outflows, and the difference is the net cash inflow or outflow from operation. We will discuss those issues in the next video. So let's start a case study with a concrete example. The Water Utilities Corporation, a public utility fully owned by the government of Botswana, whose financial statements are available on its website. The P&L as a bank function format, which is compliant with international financial reporting standards. All the figures are stated in thousands of pulas, the Botswanan currency. Remember that sales growth needs to be analyzed in terms of quantity sold and price trends. First, we noticed a big increase in net sales between the two last years, which is not consistent with data and quantity of water sold provided in the company annual report. The 12 months under review were characterized by water shortages due to a severe drought and the failure of an important dam. So we have a fast-growing company with an increase of 30% of net sales. Water sales quantity minus 2.8%. Annual inflation is 3%. And the growth in revenue was mainly driven by a tariff increase. After sales, we can focus now on expenses. Water treatment and distribution expenses rose at a slower pace than sales, but quite faster as opposed to quantity sold. This can partly be explained by the fact that during the year under review, water loss as a percentage of system input volume was at 33% compared to 28% in 2015, according to the company annual report. Administration and other expenses grew at the same pace than sales. Keep in mind that administration and other expenses are often fixed costs and should not strongly influenced by changes in revenue. While there is a slight 2.7% augmentation in staff cost, which is in line with inflation rate, the rise in accounts receivable impairment provision is very high, plus 165%. Depreciation and amortization expenses growth is in agreement with the investing policy as explained in the notes to the financial statement. The P&L of the company does not provide for added value. So we have to compute it by adding depreciation and amortization and deducting revenue grant to operating profit. We have to add 661 million staff costs, whose amount is available in the notes to the financial statement. Value added has risen by 21% between 2015 and 2016, at a slower pace than sales. The value added to net sales ratio has increased as well. This highlights the fact that the company has reduced outsourcing from a general point of view, but it is not very useful to draw a conclusion from only 2 years. The company incurred an operating loss of 242 million before taking into account a government revenue grant of 388 million. Operating loss for the previous year amounted to 319 million. The P&L of the companies does not provide for EBITDA, so we have to compute it by adding depreciation and amortization and deducting revenue grant to operating profit. According to the notes to the financial statement, the 388 million revenue grant is a non-cash income. Bear in mind that EBITDA margin is considered to be the cash operating profit margin of a business before capital expenditure, taxes, and capital structure are taken into account. A low EBITDA margin indicates that the business has profitability problem as well as issues with cash flows. The ratio EBITDA to net sales is less than 20%. So we can conclude that EBITDA margin is too low. Reduction in financial expenses is consistent with the decrease in borrowings, as we will observe in the balance sheet of the company in the next video. Increase in financial income is concerned with the interest on deposits and short-term investment. After deduction of net financial result, profit before tax and non-recurring items is still positive. The company is exempt from paying taxes on income as per the law, as it is explained in the notes to the financial statement. Thereafter, non-recurring items are low for the last 2 years, while net profit is positive only because of government revenue grant. The high net profit margin is 9.3% of sales. In conclusion, we have a fast-growing sales which hide a tricky situation. Tighter grip on staff expenditures, but control over operating expenses to be improved. Water bill not covering operating costs without government subsidy, and government subsidy needed to finance capex and financing costs. As indicated in the notes of financial statement, the corporation incurred a loss of 266 million before including the tariff subsidy grant received from the government of 388 million. There is a doubt about the corporation's ability to continue as a growing concern without the financial support of the government.